Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, it's Memorial Day, and I just don't like changing my schedule, so we're going to do some stuff today. It's a little flexible, but I have some things planned. So, first, we should get the music going. How come the music didn't pull up here? Spotify, where'd you go? Wait, what? It's installing Spotify? Markets are dead? Yeah, that's because it's a holiday. It must have been installing a new version or something. There we go. Yeah, so today, the futures markets will be open for a shortened session, but all of the banks are closed. Everybody is, and this is a holiday that pretty much everybody gets off. So, yeah. It's going to be pretty dead. I wouldn't really recommend trading it unless there's like some sort of market moving news. And so far, we have not had that. But there was a little bit of movement over the weekend. So let's just take inventory of that. Here you can see in the treasuries. Well, on Friday, this was kind of where these guys that were going short here really got destroyed. And what was it? Donald Trump tweeted something, or I can't remember exactly what it was. Oh yeah, 50% tariffs on Europe. That's what spiked them things up. You can see though over the weekend that we opened up a good clip lower. So there still appears to be a pretty significant like negative sentiment on treasuries. Another thing that I would note is I think that we probably need to spend a little bit more time looking at ZB, because you can see there, like, here's a ZB compared to ZF, right? The whole congressional bill, I don't know what we're calling it, budget deal or whatever, has been hurting the long end, not the short end. Because the Federal Reserve is still going to cut rates. So here's the S&P 500. So they got hit down by that news with Europe, 50% tariff on Europe on Friday, but they were able to recover it, and looks like we got a pretty good jump over the weekend as well. Here's oil. Still, I'd say settling into its range. Gold and silver, a similar story there. Copper. Wow, well, copper saw a huge jump on Friday. How did I miss that? That was massive. And the Japanese yen. So they had a little bit of a setback on what? I think that was the Thursday. But like they're back to the trend line. And you can see the dollar just continues to move down. So this trend may be concerning for us in the treasuries, because I think that this suggests that the yen carry trade is continuing to unwind. And that is not really a very positive thing for interest rates. Global interest rates. I'm kind of wondering if we eventually get something that is like a coordinated buying of, well, I don't think that it would be a coordinated buy of the yen, would it? I don't know what they would do. But at some point, the world may have to come in. So, you know, there's this whole thing with the Japanese yen that they've been doing the quantitative easing for a long time, and like, when is that going to blow up in their face, and yada yada yada, and I'm sure that someday it will cause some sort of a problem. Does it have to be today? Yeah, probably not this year. There will probably be some drama, but I don't think anything too significant. At some point it happens. But when that happens, there's going to be some sort of coordinated global action on it. So that's where that's going. And then Bitcoin. Well, Bitcoin had a pretty good rush up to new highs, but they're giving at least that last little push up. At least that last little push. So that's essentially where we're at. And yeah. You can see here the liquidity. Hardly any liquidity on. So yeah, it's a holiday. It's a holiday. So we've got like 2 or 3 things to do here today. The first one, well, maybe it's not the first one, but I was getting this, wanted to look at ATAS and like something. I wonder if, the kids did something and it cleared like all of my cookies and stuff, because like all of the websites aren't signed in and Trump's nuclear order and how to profit. All you need to know about the coming nuclear energy transition. I'm interested. We buy SMR, right? That's probably. The 50 best places to work in America. Oh, that's interesting. Internet searches for bias suppressor erupt after Big Beautiful Bill clears house. So suppressors are legal now? Is that what? Okay, well anyways. Okay, so I haven't heard anything back from them. Maybe if I log into their system, there will be something. But man, I still get so many people. Like, it used to be that I would get people wanting to do partnerships and deals and things like that, like every day. This was like before that market pretty much completely collapsed in 2022, right? I don't get that as much, but now I get emails probably daily from people that want to like do editing or marketing and things like that. And I was like, I don't have any money for that right now. Well, anyways, it's kind of annoying. But I think that we will maybe look at the ATAS thing later. And we're going to come over to code the robot instead. Advanced market on market imbalance. I don't know why. Market order imbalance, MOI. Yes, that's what it is. Okay. So I have a my enter long method. And I think that mostly just like does things like logging and other things. Let's come and see here. My enter long. It checks to see that it can. Oh, okay. So it's mostly adding the things to like check if it can take the trade or not. Which I'm not sure I understand that one, because I thought, oh no, I don't. Okay, well, I did it the way that I did it. Might not be the right way to do it. I'm kind of thinking, shouldn't it be, I check if I can trade. Well, it does do that, right? Checks if I can trade, and then if it doesn't, then it just doesn't do any of this logic. But I still have to have logic in here, huh? Like managing the refactory position, for instance. Or the refactory period. Well, okay. So I think what I will do is I will create my own methods down in here. I will call it public void, well, public order, manage order. What does this one, does this return a, yeah, it does. It enters an order. Long. You know what? I'm not feeling this text editor. Here's where I was. Oh, no, never mind. That was something else. Okay. So then it's going to say something like, what is the name of our thing? Book. Oh, wait. I need to use bookmarks. SPS inside BidAsk. Okay. And do I have properties in here? Inside bid, inside ask. Okay. If book dot inside bid of 0 is less than underscore book dot inside ask. And if and book dot inside bid of 0 is less than times so I think we could do, should it be double? Should it be more than double times 2? Ascend book threshold. And then do you hear about the Project X? Nope, I haven't heard of that. Sure, we'll click your link. Okay, so it's another SaaS trying to provide automated trading to people that don't know what they're doing. I'm not. Develop in Python, Java, .NET. Okay, so maybe it's not automation. But why would I use this as opposed to, say, NinjaTrader? All right, so I'm just realizing that, you know, I'm going to do stuff like enter long market. It's an offshoot from Top Step. Oh, that's interesting. So that maybe they don't have to pay the platforms? Still not sure I understand what it gives you that a platform like NinjaTrader wouldn't. I guess developing in Python might be one. Developing in Python might be one. And it allows you to access their API, but like, I guess it's free to use if you have a, let's see here. Platforms. Third-party platforms are able to integrate with our, see the data in. Okay. Interesting. Well, anyways. So anyways, I was realizing that my other method here is going to conflict with entering market orders and everything. Okay, I think I know how I can do this. I can say, let's see here. Will will C# allow me to make this optional? I think I can go like this. I can say bool limit equals false. And then here we can say if limit return enter long limit quantity signal name otherwise. Yes, there we go. What do you do? Well, today we're programming. But normally we trade Treasury futures. Hey, Paul, good morning. All right, so if it meets all of these thresholds, then it's a market order. Otherwise, it's a limit order. Passes the things. Okay. Then all these we got to change around, right? Okay. If you want to learn programming, what language would you recommend? I suppose it depends on what you want to do. I think that C# ends up being the most versatile, but you know, if you're primarily just going to be trading or programming trading robots and your platform is not C#, then you should learn the programming language that your platform has, right? If you're primarily interested in doing machine learning, you should probably just do Python because most of the tools are written in Python these days. Okay, let's see if all this sounds correct here. If the ask is less than the bid and the ask is less than the bid times 2, those are maybe redundant, but I'm going to leave them both in there anyways. And the ask is less than the book threshold. Then we enter. Oh, then it's a market order. We pass that. Okay. And this right here is manage order long. Okay. Book threshold does not exist. Of course it doesn't. Not all code paths return a value. Oh. Return. Have you ever experimented with machine learning on images of your day trading screen at perfect long or perfect short entries? How well do you think something like that would work? So I've never done that. I remember watching or reading a study where they took pictures of charts and passed it into a large language model to try and define optimal, entries and exits, and it did not work. I wouldn't expect me doing it with my screen would really perform any better. Having like a screenshot every second or something like that and passing it in maybe would be a little bit better. But at that point, I think that it's better to just be passing the actual data into the model, right? So there are some studies, for instance, where they filter the book for large limit order changes. And then every change in the book that happens that's large enough to meet that threshold is transformed into a token that essentially a word that can be passed into a large language model. And when they did that, they found that the book, at least that particular book, they were doing it with, I think, European index futures, that the book tended to cluster between two kinds of behaviors. One where one side of the book was clearly thicker than the other, and one where the activity was roughly equal on both sides. And they also found that the model was able to, what is the word that I'm looking for here? They also found that the model gave highly predictive short-term signals. So they essentially did what we're doing with the DOM, watching the major changes and using those changes as kind of tea leaves to possibly predict patterns or get an idea of what's going on in that market, or whether you want to go long or short. So, yeah. I think that the thing you've got to realize is that the machine learning is a tool, and machine learning and artificial intelligence can be very much abused. And if you really don't know what you're doing, it's not very likely to give you a strong edge. So I think that there's this idea that I'm just going to ask my LLM to make me a trading strategy, and it's going to go and build this amazing trading strategy. And the issue with that is, well, what's stopping anybody else from doing the same thing, from just going in and asking ChatGPT to build them a strategy, right? Wouldn't somebody have already done that and made a profitable strategy? And the issue is that the market is competitive. So alpha decay is a thing. If somebody's already made a strategy like that and has been successful with it, then they're going to tend to size up until there isn't any more edge left in it. And anybody else trying to trade on top of that, it's only going to be the fastest person that makes money from it, and the rest people will lose. So just trying to have the LLM do all the work for you doesn't really work. You have to do something more sophisticated than that. And the way that you do that, in my opinion, is you actually understand what the data that you're actually looking at. You understand what the market is actually doing, and you build models that are designed to specifically address that. You're also going to need to use machine learning tools that are well suited for the market, because the market has cat-tailed distributions, and most of what machine learning is doing is regression, essentially. These are all really sophisticated models based on regression or based on some sort of Bayesian model, right? And there are inherent limitations in that when you're dealing with a fat tail distribution. I don't know what kind of models help you deal with that, though. I don't know the answer to that problem. I trained a ResNet 50 on about 200 images, perfect scalp peak and trough images, and it pretty much always activates long whenever price is moving down and always activates short whenever price is moving up. Yeah. Well, because it's you. So with that one, so another issue that you have there is what is your reinforcement training mechanism, right? So if you're just training it to, you know, catch a winning trade long or short, then it totally makes sense that it would do that, right? You have to build a more sophisticated reinforcement mechanism to train it. I'm telling you, man, some of this stuff gets crazy. Some of this stuff gets really crazy. And I'm not entirely sure how they all apply to us, because a lot of the machine learning stuff that I've seen is more for portfolios. So that's what the industry does. The industry tends to trade a whole portfolio and not just a single individual asset. Right? Okay. Anyways, so next thing is we want to finish debugging our news file, huh? And I think that the best way to do that would be to add a new chart here. So the indicator, I believe, is correct, but we don't have the correct the data, that we don't have the new data file for 2025. And we kind of halfway generated one, but there was some errors in it. We were fixing them. News warning. Oh. Wait, it worked. Did I fix it? Apparently, I already fixed it. Let me see, maybe it's under live chat. I feel like that there was a message in here that I didn't receive DOM bricks. Maybe because you put in a URL. You probably tried to give me a URL and it won't let me see it, because YouTube is lame like that. Even when I try to allow URLs on the channel, it still filters them for some reason. How is that? I swear we weren't done fixing that. And yet, there they all are. There's CPI. Ah. Well, I'm impressed with myself, I guess. Could have sworn that the news file was still broken. Okay, well, we should upload that at the very least. I'm pretty sure we didn't do that. What do I use? WinSCP, yeah. I'll do that on the other screen, though. Fine, we'll upgrade WinSCP. We should, I guess what I would say, not knowing what the thing you were talking about was, is that in general, there can be really powerful edges to be found in reading order flow, because the price itself is the result, and there's a lot of noise in that. So what you want to do is you want to look at how that price was created, which is looking at the orders. Once you start to analyze the orders, then there are stylized behaviors in there that, you know, are very different from what would be random, and that can be predictive. Although it is, again, competitive, so a lot of those signals tend to be really short term. So a lot of the time it is the order flow doesn't give you, the retail trader, an explicit advantage as much as it does, it keeps you on sites. It prevents you from doing something stupid. And you have to combine it with other edges that you have to really generate a really, really strong edge. That's often the case, right? So any kind of order flow tool could potentially give that to you. And the question is just like, what is that tool doing that is unique? Is it doing something that I can't do myself just from looking at the DOM? Or that I can't do with, like, say, Seth's order flow tools and the tools that are built into the platform if I'm doing algorithmic trading. So, oh yeah, I was stalling when SCP. Man, this chair, I like this chair. I want a nicer version of this chair. My chair at work sucks. Oh, I did update it. Okay. I could have sworn that what happened was we did all this and then it didn't work. And there was still something that we needed to fix, and it hadn't gotten around to it yet. What do you think about measuring the randomness of price movement with Shannon entropy? I've never heard of that before. All right, well, I guess since I did the two main things that I needed to look at today, we can look at that. Let's minimize this for a little bit. Oh, okay. Yeah, when you said Shannon, I was like, that sounds familiar. Well, Shannon was the guy that developed a lot of the data science around that stuff. Somebody made an indicator. It's a measure of the information content of data, where information content refers to more to what the data can contain. This sounds like an indicator that you probably downloaded on TradingView, isn't it? Come on. You were just chatting with AI, of course. So we're gonna waste our time with the AI. All right. Source code. Shannon entropy. Okay, what's this? CR. It's SRC. SRC equals the close price. So, and len equals a window, like 9. Okay, so then they say okay, this is basically price divided by 9. Log of the volume divided by the sum of the log of the volume. Now this one is pretty complicated. It's using logs and everything. Dang. I don't know, man. That thing down there looks pretty freaking random. Settings. Well, that's interesting. There's an example where it wouldn't work. I don't know. This doesn't look to me like this is doing anything too different from like what do we call this thing? It's an oscillator of some sort, like it's like a high pass filter of some sort. Fisher transform. Yeah, it's a little different though. Because it gives you these waves. It does seem like sometimes when you get a big move that it turned around at the right spot. Otherwise, it's random. There seems to be a fair amount of electrical signal there. Yeah, well, but again, like, so the main thing that I was looking at, like when we had the code up here in the Pine editor, right, is, okay, what is it actually doing? Essentially, it is running transforms on the closing price. So if there's too much noise in the closing price to generate effective signals, then why would running any kind of transform on top of that, regardless of what it is, provide an actionable signal, right? The only way that the price is actually going to help you is if you have some other piece of data that you can combine it with to filter out the noise from the price, you see. So when I come in, and so as soon as I came into TradingView and found that it was an indicator on TradingView, I was immediately like, okay, this probably can't help us too much. Because TradingView, generally speaking, can't do order flow stuff. And you might have something where, you know, you're using multiple data series. You can, but probably it's not going to. It's kind of funny when you talk into the chat GPT, because if you prompt it the right way, see, the thing is, you got to remember that the way chat GPT works is they've passed this huge set of data into it that essentially allows it to like map out the human language. And so it's basing its answers on stuff that it's read online, essentially. So if you come in and you ask it for trading advice, and the way that you ask it is like the way that somebody would ask the question on Reddit, then what it's going to do is it's going to go and it's going to find Reddit threads, and it's going to find the suggestions from Reddit threads with some amount of randomness, right? Whereas if you ask it in a way that is like the way the question is asked in empirical scholarly research, then it's going to go and it's going to try and find the scholarly research. But the issue with the scholarly research usually is that it's geared more towards institutional trading. From what I've looked at so far, mean reversion strategies based on price seem to be the only thing that work for the strategy I tested, like buy or sell based on how far the price is from standard deviation. Well, yes and no. So what you're going to find, so here's like the real, so there's, I already kind of gave you one rundown where, you know, I was saying, well, there's too much noise in the price. How do you separate the noise out, right? There's another way of approaching this from just a purely algorithmic side, which is I can come in and I can generate some sort of a trading signal, like a mean reversion trading signal, right? Price gets too far away from my moving average, or I'm using Bollinger Bands. Is like price gets too far away from my moving average, then I take a mean reversion trade, right? There's much more sophisticated ways of doing a mean reversion, but that's probably like the most naive, straightforward way of doing mean reversion, right? Is just use a Bollinger Band and trade it when it moves outside of the Bollinger Band. And what you're going to tend to find is that the indicator will, or that the strategy rather, what you'll tend to find is that the strategy works really well sometimes and really terribly other times. So essentially you get this what we call regime switching problem, which is that the market tends to switch between mean reversion and trending market regimes. And so in order to create a profitable strategy out of those two different regimes, you have to have some way of detecting which regime we are in. And a lot of the time, or at least as far as I can tell, like on that particular one, whether we are in a trending or a mean reverting regime is random, or rather is not predicted by the past data. I can predict when it's going to be trending or mean reverting sometimes, based on information that I know about the market that tells me whether large players are going to be active in that market that day or not. But that's information that I can't really get into your Ninja Trader strategy. Right? Because I'm gathering that from a large number of sources that are both public and private. And those are data sources that are in a human readable format and not necessarily a format suitable for algorithmic trading. So getting them into that format and then predicting which regime we're going to be in it's too difficult of a problem, right? ATR sort of gives you, that's another way of looking at it, is that like the options guys, they will tell you that there is just no way to build a profitable trading strategy from outright trades on a single instrument. That's what the options guys will tell you. They'll say, that what you get is just a function of the volatility and luck. And there's like mathematical proofs of this. I think that the flaw with the mathematical proofs of that is that there are things that can predict what kind of orders people are going to submit, right? So again, that comes back to the quintessential issue with price, that there's too much noise in it. It's too difficult to generate a signal based off past data. So what we do about it is, for the primary edge I'm relying upon is primarily informational. I read about the markets. I try to understand as much as I possibly can about my specific market so that I am an expert in my specific market and know when there's information out there that could potentially predict what orders are going to come through in the next 5 to 30 minutes that the market isn't properly factoring in. And then everything else that I know, all of the research and patterns and market data, is all there to just support that edge. And there is some empirical research and data that can help you. It's just, from what I've found in my research, it tends to be order flow things rather than analyzing price. Or it's analyzing like a whole portfolio of things, right? Like, I think that this is really where retail traders got screwed up, okay? Because like back in the day, it started out there was chart patterns, which, by the way, chart patterns were based on daily bars. So I really think that trying to apply any of these things to intraday charts is like a fundamentally different thing. But I digress. That's not relevant to the specific point I want to make right here, which is to walk you through the history, right? So I think that the first thing that kind of happened that kind of led retail traders down this course was Wilder. Wilder released his book, and that kind of created indicators, right? Before that, it was primarily chart patterns, right? Which I would essentially call price action. Price action is based largely on chart patterns, whether you're making new swing highs and lows, candlestick patterns, things. That's largely what price action is doing. Then Wilder came in and was like, oh, well, we can have like these moving averages and Bollinger Bands and RSI and all of these sorts of things, right? Well, remember, they were still working on daily data, essentially, right? So that kind of got popular, but then I think the thing that really, really kind of like cemented it as like the culture in retail trading was to look at charts, was the turtle traders in the 80s. So these guys, they went and he kind of developed the strategy, and he found that, well, there's a strategy that like you're wrong most of the time, but when you are right, you make so much insanely amounts on the ones that you're right on that it makes up for all of the losses, essentially. And so what they did was they would trade a portfolio. They would be like, okay, when I'm getting a new 50-day higher low, then I will enter long or short into that asset, and I will stay in it based on all of these rules. And I'm doing that across a universe of assets, right? Because if you take one individual thing like treasuries, for instance, they might not trend for a really long time. Treasuries can go years and years and years, just range bound, make any money from them. So, but if there's always something trending, so I have to trade a universe of assets. It's a portfolio theory, portfolio strategy. So you got two key issues here, right? You have a profitable, well, three key issues. You have a profitable strategy, but there's three things about it. One, it's a strategy that's run on daily bars. Two, it's a strategy that's run across a portfolio. And three, it's a strategy that requires a reasonable amount of money to deploy, because you're going to be deploying it across multiple instruments, and you need to be able to size your positions to manage the risk of each individual position, right? So momentum becomes a really great hedge fund strategy, but not a very good retail trading strategy, because you want to just come in and trade one thing and take outright positions on that one thing. It's not going to work, right? Because it might not be trending. These are things that again, they work on daily bars, are intended to hold the position for months and over a portfolio. But when they made the books, they started making all of the books about these guys. They didn't really, I don't think that they knew that. Like from their perspective, it was like, well, it works this way. And I don't know if they completely understood why or how it worked. Oh, sure. Why wouldn't it work for day traders? Well, it doesn't. I'm just telling you, it doesn't work for day traders. But they never made that distinction. And so what happened was retail trading built up this whole kind of set of rules and things like that, all based on momentum strategies, where they were misapplying the principles of momentum strategies. Right? So that's basically where we got to where we're at today. When is AI going to be smarter than a multi-dimensional word cloud proximity? I saw this article the other day. I don't think that I would be able to find it again, because it was getting downvoted, but it was like a very long article. It was very, very smart, and it went into a lot of scholarly, like, philosophical questions about AI. And the author's point essentially was that consciousness would not be just an emergent property of a really highly developed neural network. That in order to have, consciousness, you have to have something watching the neural network. And the molecules to do that just aren't there. It did kind of support the argument that consciousness must be a quantum phenomenon, but we don't have any proof of that. So his argument was basically that artificial intelligence was missing something fundamental to what makes us conscious, essentially. So consciousness is, well, he went into that too. I tell you what, I wish I had the article for you guys, because he went a long way into like what actually is consciousness and how do you define it and so forth. But he was doing it, he was really taking a mathematical approach. He was basically showing, so like one of the things they were talking about was like, well, if it's an emergent property, therethere's like when you take a neural network like that and you try and make like a subdivision of it, you're talking about an NP equals NP incomplete problem where, it scales exponentially and at the size of neural networks. So we're talking about, the number of iterations that it would take to find if there is a subset of that neural network that is able to do this is larger than the number of molecules in the universe. And so there would be no way to find it if it was there. But then he also showed that in order to have something that's looking at it, you actually have to have neurons or particles that are looking, and those aren't there. So the consciousness would have to be some other mechanism beyond just what we see with the connectivity between neurons. And there's definitely stuff going on there that we don't understand, right? Like a nerve cell will get a signal, and then like, why does it propagate it the way that it does? Right? Like in a neural network, we give them different operations. We don't understand how a brain cell does the operations. So educated guess regardless of what data. Well, yeah, but I'm just kind of going down through like the research that we have and what we do know, right? I mean, so let me take this a different approach to this, right? There is one really high level thing that we know about markets that is really super significant. It completely changes our entire view of the markets. And it's kind of something that's always been treated as an open question in the markets, but we have in the last 40 years essentially conclusively proven. And it has to do with the efficient market. Is the market efficient? Well, what we've found is that you can think of the market, you can think of market efficiency from multiple different angles. One way of looking at market efficiency would be if I analyze all of the past price history data, is there information in that past data that can help me see the future? That can predict what it's going to do, what that individual asset is going to do next. So we call this statistical efficiency or technical efficiency. And what we find is that when there is an inefficiency, like they do exist, but when these are found, people start to trade them and the market that changes the way that the market behaves. And so those effects don't last for very long. They're very, very easy to remove from the market. So we say the market is very statistically efficient. Granted, momentum is a thing, but when you get into it, you can kind of see how these two things kind of lead to momentum being possible. Okay. Now, there's another way of looking at it, and that is there is some sort of fundamental price that must reflect all available information, right? So the best way of looking at this one is looking at assets where the intrinsic value of the asset is very easy to calculate, right? So I'm kind of separating between intrinsic value and fundamental value, because something might fundamentally be valued differently if I know something about that industry or something like that, right? But intrinsic value is something that like you should be able to calculate, right? Especially, for instance, in bonds, right? In bond, there is an intrinsic value. If you bought that bond right now, you get a certain interest rate, and you can calculate over the life of that bond exactly how much you're going to make from purchasing that bond. So the intrinsic value of the bond is directly calculable. And you know what we find is that when you calculate that intrinsic value, the market price is almost never at that intrinsic price. And in fact, it can be extremely far away from that intrinsic price, and it can stay far away from that intrinsic price for a long, long time, if not indefinitely. So why is that? Well, all orders have impact. So if somebody is coming in and they're a large fund and they have to buy or sell a lot of a thing, when they buy or sell, it's going to move it, regardless of what the quote unquote intrinsic price is. And furthermore, those moves, we have found that the market has a long memory. So if you come in and you buy a ton of things, traditional market theory would say, well, that's a move away from its fundamental price, but now that that move is gone, it should revert back to that. But we find that that's not the case. We find that the impact is permanent, and in order for it to go back down, you would have to have another large trader trade it up or down, and that doesn't always happen. So the key thing here, if I were to summarize all of that, is the market is very statistically efficient, but not very informationally efficient. Once you understand that, that kind of changes your whole view of the market. So for starters, I think that it gives us pretty significant hints as to how we as a retail trader trying to scalp should approach the markets, right? Because if I'm coming in here and all I'm doing is looking at price and trying to find some past pattern in price, the market is very statistically efficient. So it's going to be extremely difficult, although not impossible, but extremely difficult to find a strategy like that. You're probably going to have to do something incredibly sophisticated to do that. Like you're probably going to have to be like a PhD in data analysis and things like that to find that. And then when you find it and you share it with everybody else, it'll stop working, right? But the market is very informationally inefficient. So there can be all sorts of information that we can know about potential future buys and sells that will predict where this instrument is going to go in the short term, that the market is not factoring in. So nobody else has traded it yet. So there are opportunities for you, but there's kind of this other issue, which is like, because it's so inefficient, just because you take a trade doesn't mean that after you take the trade, suddenly the market's going to be efficient and it's going to go the way that you want, right? If the market's not factoring it in right now, what makes you think that it's going to factor it in the future? So you have to have some sort of a catalyst, right? You have to be able to take some trade and have some sort of catalyst that you expect to happen but hasn't happened yet that will suddenly cause everybody else in the market to realize what you know and trade it up, essentially, right? And that is the primary place where we as retail traders can find an edge. Do you see what I mean? That's how we get to the you want to build an informational edge. Yeah, the intrinsic value does not mean anything if the market values it differently. Yeah. But I mean, even if there was some other valuation that the market comes to, the market will almost never be at it, right? Okay. Now, another kind of consequence of this is that it can kind of change the way that we analyze the market, right? Like if we come over here and we look at what the Treasury market has been doing lately, well, maybe we should go to a higher level one. Well, a lot of people will say the Treasury market has been selling. That must mean that something fundamental has happened to change the value of treasuries. Well, not necessarily. Because again, the market is not obligated to, it's not informationally efficient. So this is not a record of what an asset is worth from a fundamental perspective. This is a record of the people buying and selling. So during this period over here, I think it was this period, there was actually some very significant selling from sovereign wealth funds that, as far as we know, had nothing to do with any kind of fundamental picture or change in the market. Essentially, it was we suspected that it was a good buy over here simply because of where we expected the Federal Reserve to go, and we understood that this selling was not anything to do with that, on anything to do with the fundamental picture, so we just ignored it. Basically, I keep track of what the fundamentals are saying separately from what the price is saying, and then every day I come in and look at what were the flows, and this move happened, the timing of the moves, and what kind of reporting that we get from, there's reporters that talk to trading desks and things like that, so that we can get some idea of why they were trading it, to see what the situation is. So when we come over to this one, well, we know that this initial spike was because of the trade war. There was a flight to safety because of trade war. This first part was before that. This first part was, well, the Federal Reserve is going to cut. We don't know why we sold down so much, so people were buying it. Then the trade war happened. Then that kind of got short-circuited by some selling that we're still not quite sure what it was. Some selling that we're not quite sure about. But in July, we will know if it was Japan or China or whatever. I kind of suspect that it's Japan. Japan's been having some issues. So I suspect that Japan sold some treasuries to shore up their currency. Then we got, this was over with. The trade war was like, okay, not that bad. Federal Reserve's still probably going to cut interest rates by the end of the summer. Kind of turned up. And then this right here would be, I think, primarily the budget deal being negotiated in Congress. Seems to have affected the longer end of the curve more than the shorter end of the curve, which would make sense. The longer end is kind of driven more by the fiscal state of the country, and the short end is driven a little bit more by what we think the Federal Reserve is going to do in the next year. Right? So does that mean, because I see a lot of people now, we're in this kind of range. Well, I look at that and I'm like, oh, well, we're ranged. And I've been sitting here trading it every day too, right? So I can see the state of the market. And it's been slow. It's been a slow market. The past 2 weeks, it's been a slow market. It's been, we've had some days where we came in and for our whole trading session, it didn't even move like 6 ticks. There was one day where I think it didn't even move 6 ticks. It was terrible. It's just absolutely dead market. It feels to me like they've already left for the summer. And meanwhile, all these retail traders that they think that the market is, perfectly informationally efficient, are like, oh, it's down. That must mean something fundamental, and it's going to go lower, and yada yada yada. Well, no, not when we can kind of trace the orders. When we trace the orders, what is our perspective? Okay, well, there was some selling for reasons that impact is permanent. Now, without anything else happening, we're likely to go sideways. And so the only way that I can predict like what the next leg is going to be, whether it's going to be up or down, is if I can predict the future orders. I'm a little bit skeptical about the trade that has to do with like fiscal responsibility, because what triggers the next set of orders? Like they already passed the bill in the House. I guess that there could be another wave when they pass it in the Senate and another wave when he signs it. But then beyond that, like shouldn't that be like the maximum amount of selling on that particular thesis? And at that point, wouldn't it be likely to unwind? Right? So that one doesn't necessarily make sense for me as a trade. And I still think that they're going to cut interest rates by the end of the summer. I think I'm still of the opinion, I said this at the beginning of the year, and I'm still of the opinion, I could maybe move it back a little bit, but I think that if we keep interest rates where they are for too long, it will send us into a recession. That on its own will send us into a recession. So I think that they're going to cut. Well, anything except arbitrage as an educated guess is maybe true. I mean, sometimes we can have really good information, though, that's not, I wouldn't call it an educated guess. Like, sometimes we can totally know something that the rest of the market doesn't really know. It's still going to be an educated guess as to whether or not the flow comes, right? That's always a little bit in the air. Because what you think is a big deal, maybe other people are like, yeah, it doesn't matter. Doesn't matter, Not sure the Fed will cut by. Why? What inflation? What inflation? I'm not seeing it. Last PPI, CPI report. Well, that one was really funny because it was like, we got the CPI and the analysts didn't really expect inflation, but I think that there were some retail traders in the market that were expecting inflation and they didn't get it. So it was like, oh, but maybe we'll get it in PPI. And then the PPI number came out and it was actually deflation in the PPI number, which was like really confused some people. Like, what? How is that possible? Yeah, the market does seem like that they are on summer break already. I agree. Absolutely. Very much. And this is something that we see very common, actually, is if there's not something else going on, as soon as like the major economic reports for the month are over, so like the first 2 weeks or so, or when most of the economic data comes out, and then they leave for the summer. I mean, after Memorial Day, it's usually really bad. We'll see. I'm going to bet you that tomorrow, when the market opens, that they're not going to have 3,500 contracts at every price. It's probably going to be more like 25 to 3,000 at every price. I don't know if that's true. De-dollarization is occurring. Nobody wants our debt. The world is making deals without us. Where has that happened? The yield will have to soar to entice foreign buyers. So this kind of view of why people buy treasuries seems kind of silly to me, to be honest with you. Do you really think that people sit there and watch the news and are like, yes, I think I would like to own US debt. It just seems like I really like those guys. I'm going to go and buy US debt. Right? Like that's projection. That's the way that we think. We think, oh, I like this company or I like this country. Maybe I should go and invest there. That's not the reason why the money goes into treasuries. The reason that money goes into treasuries is because they literally have to have them in order to conduct business. Okay? Nobody buys treasuries because they want to. It is a tool that accomplishes a specific task that they have to do, that they have to have to conduct their business. For some, like a pension fund, they need an instrument that is supremely safe but protects their money from inflation. So, treasuries. You get into treasuries, and as long as the interest rate that you get is higher than the rate on inflation, then your money is safe. And that's why they invest there, right? Okay, so if we were going to have inflation in the United States relative to the rest of the world, and that inflation was higher than the interest rate that you're getting on the treasuries, then that would cause people to not want to buy it. That would cause people to not want to buy it. Except for that we're not seeing that inflation. We're not seeing that inflation. And in fact, the expectation from at least the analysts that kind of look at this, they say that inflation is going to be 3% with the tariffs. So it's 3% and you're making 4.5%, right? So, you're making 1.5% to 2%. So that doesn't make sense as a reason for them to not do it. Now, if you're planning on doing less business with the United States, that might be a reason for you to not buy as many treasuries. But again, we don't seem to see any evidence of that. In fact, I think that the thing you might want to be, like if you were short treasuries, for instance, I think that the biggest risk to you would be that some sort of a deal is done that essentially ends up resulting in these countries buying a lot of treasuries after the deal is done. Right? Now, I suppose there is one thing that happened that kind of says like, people don't want US debt, right? And that was the 20-year auction last week. But remember, the 20-year auction is a weird auction. You have the yield curve. Some people want to be out on the 30-year because that's the one that's the furthest out. And so a change in interest rate affects that one more. So the 30-year swings. You make money on 30 years. Some people like 1 year and 5 years because those are going to be more sensitive to the short-term changes in particular things, right? And the 10-year kind of sits in this perfect middle ground between those two, where it is sensitive enough to the short term and to the long term that you really get good bang for your buck, essentially. And that's why the 10-year is the most active part of the curve. But between the 10-year and the 30-year, why do you buy in there? If because if you want to have the more duration, then you're just going to go and buy the 30s. And if you want that kind of more balanced area, you're going to buy the 10-year. So why would you do halfway in between? The 20-year has always been essentially the lowest activity part of the curve. Now, there was a point for a little while where they made the 20 years like special in auction. Essentially, they had to add sweeteners to encourage people to buy 20 years. And so there's been some periods, because it's been like the whole thing since 2022, right? Where we've had auctions that didn't do very well and all of that. It was often the case that the 20-year did really, really well, but that was only because they had those sweeteners on it. Now that they don't have that anymore, people just aren't interested in trading the 20-year. Okay. And there's the issue in the Japanese bond market, because in the Japanese bond market, there basically isn't a bond market anymore. It's like only the Bank of Japan that's involved over there. So that's a different thing, right? So that event last week, I think that it's something to take note of, but the idea that you're going to trade and change your fundamental thesis based on that, which is what I see like most people in the public sphere doing, I think is absolutely ridiculous. I'm skeptical on all the dollarization narrative, yeah. But I mean, we should note that the dollar is weakening, so. I think it is true that the dollar is less of a dominant force in the global economy, or at least is headed to be less of a dominant force. It will still be the most dominant currency, probably. But right now, it is so incredibly dominant that it's really kind of harming the United States. And so they are trying to change that, and they probably will change it. So, you know, if the trade was go short the dollar, I think that trade makes sense right now. Going short the dollar, I think, makes a lot of sense. Going short U.S. Treasuries, especially if you were going short on the short end of the curve, that one I don't think makes as much sense, because there's still this issue of the interest rates are high, financial conditions have been tight. Some parts of the economy are doing pretty well, but other parts of the economy that have kind of been the drivers of the economy for the past 20 years are really, really hurting. So you can only have that interest rate at that high level for so long before it just completely undermines the economy and causes a recession. That's why the Federal Reserve keeps talking about normalizing interest rates. And the market has pushed back there, and when they anticipate that happen, and that's typically what the markets do, is it often happens much later than the markets think that it will. But right now, we're saying August. And if we don't get it in August, then we start getting into like quarter 4 for these sorts of things. That's when I think you start to get a recession. So, if they're going to have to cut interest rates, selling treasuries doesn't make as much sense. I don't know how many people are short. I don't know, is a sovereign wealth fund going to come in and sell more treasuries or something like that? I just don't, well, I can't predict those guys, but I just don't see it happening. And then there's the whole fiscal side of that. But everything that I've seen from that is that it's mostly retail traders pushing that, and that the large players haven't gotten involved the past 2 weeks. So especially when it comes to the budget deal negotiations, I think that whole narrative that like interest rates are rising because of what's going on in Congress, I don't see that at all. There's no evidence of that in the flows, at least. Japan will pop the bubble just when is the golden egg. Well, that might be. right? Trump wants rates lowered. It would cause a squeeze in bonds, emerging our short forwards heavily, and the dollar has to go down for debt. So emerging will print on forwards with weak. Yeah, I think that he does want lower interest rates for sure. This kind of transition in the economy that they want to make, where we start bringing sophisticated manufacturing back to the United States, will require lower interest rates in order to fund all of this investment activity. Right now, you just can't really invest in business and kickstart things with the interest rates as high as they are. Is it relevant to day trading? I beg to differ. I mean, no, understanding what has driven past flows is going to really help you predict what will help you predict the future flows, rather. What is this about the Houthis just kicked us out of the Red Sea? I mean, there was some military action on that like a month ago, and the Houthis stopped after that. That one was, I think you're a little late to that one. Of course, they could start it back up again. But the last thing I heard on that was the US and Saudi Arabia started hitting them really hard, and it only needed to go on for a few days before they were like, okay, we won't attack your ships. Predicting a rate increase the end of summer is bold. It was certainly not bold. I don't think that something that 60% of the market is predicting is bold. Actually, we should check. I don't think it's 60% anymore. The next meeting is in 23 days. So September. Okay. So yeah, it's basically so there's a 46% chance of one cut, and then if you add these together, right, then it's 57% chance. Really more like 59% chance that there's one or two. So how is that bold? That's just current market pricing. Doesn't mean that that's what's going to happen, because remember, market's not informationally efficient. But like our best prediction is going to be the market price, at least to start with. So to call that prediction bold, I think is pretty ignorant of where the market pricing is. Okay. You seen Brigitte Macron slaps Manuel in the face? Oh man, no, I haven't. I've noticed that I shouldn't say this, but ever since what's that crazy I don't want to what is her name, that this conservative influencer, and she started looking into whether Macron was like actually married his dad or some crap like that. I don't know. It was this really out there conspiracy theory. Candace Owens, that's right. She was investigating whether Emmanuel Macron's wife was transgender, essentially. And anywhere that she looked about it, they just kind of shut her down, which they thought was kind of suspicious, right? And I've noticed that since that came out, that like anything in social media about Emmanuel Macron just seems like it's suppressed. So I haven't seen. Oh, this is brand new, huh? Yeah, she was saying that he married his dad. Which was like, what? Oh, he did get... Wait, I don't know if that's what that actually is. I don't know if that's what that is. That's kind of weird. Oh, that's kind of a weird video. No. I think this is kind of a really naive. So I know that Pig Iron is our regular troll, and we can ban him soon. But he's talking about something that I think is a really common misconception among retail traders that I really feel like needs to be corrected every time. So just because the macro picture is not relevant to why the market is moving at this exact moment doesn't mean that it's never going to. There's going to be a point at which there are orders flowing through because of a change in the macro picture. And when that happens, that's all that matters. And those are the biggest moves. So you've got to be prepared. And how do you stay prepared? By looking at it every day and reading all of the news and keeping up on that situation so that when it is relevant, you understand it. You understand what's going on. And the better you understand those things, the more likely you will be to be the informed trader in the market in a situation where it matters. So we need to look at these things. And we need to look at, this is the other side, is that they'll say like, well, the macro picture doesn't matter. But then when we do get a move, and we're trying to figure out what it is, they'll be like, well, it doesn't matter. No, it does matter. It does matter. Why is there this huge flow coming in? What's the selling? Is it a sovereign wealth fund? Is it something that we could have predicted? Like, understanding why can really, really help you to predict future flows. Yeah. Your point is to look at the macro to anticipate order flows and ride the trends. Yeah. I mean, it's not just macro, but that's probably one of the biggest and most useful ones. I tell you what, like, it's kind of funny. I've been listening to the Strong Source podcast, which is a podcast hosted by a former senior trader at Cargill. And so he really, really knows the commodities trading world, and they're having top professionals in the commodities trading world get on and interview them. And, their approach to things is completely different to what like a retail trader approaches, because what they do is they come in and they analyze the supply and demand of a market, and they make a spreadsheet up and then come up with a fundamental case for why they think that the current price is oversold or overbought, and take positions up with that, all while, managing that position with actually like producing the commodity itself, And so they are essentially fundamental traders. And there is a lot of momentum funds in their world. Momentum fund will come in and start buying corn or oil or whatever the commodity is, chocolate. For him, it was cocoa. he was a cocoa trader. And so there's often been times where cocoa will just go absolutely crazy. It has nothing to do with the fundamentals, and then all of the funds get involved. And they kind of laugh at the momentum funds because the momentum funds will often get into that market in the situations where it's really bad position, where it's a really bad position and they know it. But since the momentum funds don't know what's going on, they can't do anything about it. So what kind of edge does Jigsaw give you? Oh, many different ways. So I would split it into 3 separate categories in which Jigsaw helps you, okay? So the first one is that it is a very effective way to submit orders. There's nowhere else where I can directly click on the price and decide whether I want it to be a market order or a limit order, things like that. Like there's chart traders, but when I do the chart trader, first I have to move up and down until my thing tells me that I'm at the right price. And then I probably have to right click to tell whether I'm going to buy or sell or whether it's going to be a market order or a limit order. Okay. So it's much easier to do that over here on the DOM. Okay. The second thing is that there are very short-term kind of things that you can sort out to determine whether you should use a market order or a limit order, or if you're using a limit order, at which prices to submit them to. So in this situation right here at 0.1/2, if I want to sell, it doesn't really make sense to market sell at 0.1 because your chances of getting filled on limit at 0.1/2 are pretty good. There's only 400 contracts there. Granted, it's a holiday, so this is a bad example because it's a holiday. But under normal circumstances, they're very likely to tick up. So you're better off putting a limit order there. Okay. There might also be an iceberg. So when there's an iceberg in a place like that and it's like refreshing, that's a good place to get a limit order as well, because you will get filled and there's going to be more limit orders behind you. So it will be harder for them to push through you and give you that adverse excursion. If I've just, this all kind of presupposes that I've already decided that I want to go long or short, right? So that alone is, those 2 things alone are very good reasons why literally every futures trading day trader should be using a DOM for their execution. Okay. Those two things, those are pretty significant edges. I think that you kind of want to see, okay, how is this going to be the thing that tells you that it's going to move 16 ticks or whatever? But I'm telling you, 1 tick on each side of every trade makes a huge difference to your performance. Okay. So that is a really big thing. Okay. But then the other side of it is that you can kind of tell from watching the changes. So, one order adding or canceling here doesn't really tell you very much, right? But you can kind of watch it over time when there's a large enough changes. And then especially when things happen like, a big market order comes and hits the market, how do all of the limit orders react to that? And at each point, I'm watching for those changes, and those are kind of like tea leaves. Those are kind of like tea leaves that give you an idea of what that market is doing and what the latent liquidity conditions are. Whether this is an area of relatively healthy latent liquidity or very low latent liquidity, in which case price has a tendency to kind of get stuck in those areas of low latent liquidity. Okay. And those can all really inform your other edges. So if I'm coming in and I'm expecting to see buying today, but then, I see a buy and I don't really see the other orders react to it, or I see them react kind of like, oh, I like that it moved up, I'm going to put even more on there. That kind of has me going like, maybe I'm wrong. Maybe because the market is not reacting to that the way that I think it should. Cumulative delta is also really, really useful, but cumulative delta you can't really see on the DOM. That one is, it's there, but that one's kind of hard to track on your own, right? So that's better to have a chart, right? Okay. So these are the three kind of ways that the DOM, I'm not going to say just Jigsaw, but any suitable DOM helps you. It improves your edge. And a lot of things in trading are, you know, just adding a bunch of little edges together. This is where you all of a sudden you can get something that's really, really powerful. In NinjaTrader, you can buy or sell in the DOM. You can. It's the order entry is not as good for starters. Like if you want to switch between a stop order, you have to add like a key, or there's a bunch of settings to it. It's not very good. The biggest issue with the NinjaTrader DOM is that in order to really see like what's happening with the market orders, you have to add these columns that go like way over here. So not only is the information not where you would like to be able to see it to analyze it against the limit orders, but it like takes up, there's like huge wasted space. So to put all of the information that I have on here on my Jigsaw DOM, I would probably need like 2 screens to do on the NinjaTrader DOM. So that's the big problem with the NinjaTrader DOM. It's a west side. Wait, why would I be a west side version of John Grady? But, you know, I think that a lot of what I am trying to do is I'm trying to, because I think that John Grady has a really good starting point, right? And then there's kind of context, and that's kind of like, you just kind of have to figure that out, right? That comes with experience and time. What I'm trying to do is I'm trying to provide you a framework through which you can build that context. So here is what I've given you today is kind of a rundown of why the context matters and how to interpret the context, right? We are trying to predict future flows, not necessarily fundamentals. That now I can look at what's going on in the market and who might be potentially acting in the market that day and read the order flow with that information in mind. Because again, market, but you know, even there's price is random, but even with order flow, like these market participants, they don't want you to know what they're doing. If they're going to buy a ton of, they don't want you to know. So they try and hide it. So when you're just looking at the data on its own, it's pretty hard to separate and understand which way it's going to go. But when you add the context in there, when you have predictors of order flow, you know that this player may potentially be buying, you could kind of know based off of what type of player they are and how big of an imbalance it is and everything. You can get hints in the order flow that support or reject that thesis. So it's basically, it's an additional piece of information that when you use it as a filter on the order flow, all of a sudden you can see what's actually going on. Oh, okay. So when you say west side, you mean like the west side of the United States? Yes. Well, Intermountain West. I live in the Intermountain West. I saw an article on how to make an exact replica of the Jigsaw. Yep. I'm not a fan of this here chart platform, but it does have all of the stuff necessary to do what we do. And it is quite popular. I was kind of looking at this like, wow, oh, you know what? That one's the ES though. There you go. I'm kind of feel like, well, it's up at the highs, but like it's a relatively quiet day, but the amount that it's moved up for a holiday is pretty good looking. So I don't know. I tell you what, I've been struggling lately with like, we only have 90 minutes to do this stream. It's definitely shown in like metrics on YouTube and things like it really crushes me. Like, I'm happier having a day job and having a ton of work to be able to do and not have to stay home and watch toddlers all day and feel like I could be programming or doing something more productive. But it really, really hurts to not be able to stream as long. And now today, we are able to stream as long as we normally would because it's a holiday. And it's gone by so quickly. Okay, I don't understand Jigsaw's pricing model. It seems like even if you buy a lifetime license, you still have to pay $500 a year to use it or something. Well, so they have a live trading license that's $50 a month. So in order to submit live orders by clicking on the DOM, which as I just kind of ran through is kind of like the most useful feature of it, you do have to pay. Now, it seems like on the face of it that Sierra Charts is significantly cheaper than that. But the problem is that Sierra Charts kind of hides the cost from you in the form of like its package. So like they'll come in and say, oh, you're only paying $15 or $30 a month to be able to have the advanced order flow package, right? But then there's also the data, which you're also paying to Sierra Charts, whereas with NinjaTrader, you're paying it to Rhythmic or CQG, right? So when you combine together all of those monthly costs, you're going to find that Sierra Charts is pretty close, if not slightly more than Jigsaw. But Jigsaw does still have the $500 license up front. So yeah. So ultimately Jigsaw is more expensive, but primarily because there's that upfront license cost. You're paying $500, and you know what? Like, that's, you get what you pay for. So yeah, you'd have to put it in as an Excel spreadsheet. And I mean, the issue is I've many times thought, hey, let's make a video where we go through costs and we can say, okay, here's how much you pay for this platform, or here's how much you pay for this broker and how much you pay for this. But the problem with that is that it changes all the time, right? So it changes all the time. As soon as you make a video, it's outdated. The cheapest way for, let's not call it level 2 data. Let's call it depth of market. Cheapest way for depth of market, Apex combines it. No, can you get Apex combines for $15 a month now? That's crazy. The issue is how your orders are routed too. Well, I've never had problems with neither Rhythmic or CQG though. 90% off. Well, I guess it's 90% off. Except for that, like, you're not actually, I don't really feel like it counts if it doesn't give you live orders, you know? $15 a month, yes, but you're on Sim. No, it is Sim data. So first of all, the data provider, like, that you connect to, like if you're doing Rhythmic, the server that I connect to when I'm live is different from the one that you connect to when you're on a prop firm. They're like different environments for them. They're maybe like hosted in the same cloud or whatever, but they're like different environments, right? And what you will find happens Oh man, it's been a while since we've had one of these, but I guarantee you it will happen again. What happens is when the market becomes really, really active, so much so that their systems have a hard time keeping up with it, they will send all of the compute resources to the production environment at the cost of everything else. So anybody that's on the platforms or on SIM gets their data gets delayed, essentially. And that does happen. Surprisingly, I don't think it's happened during this period with Donald Trump tweeting and stuff, but we have seen that. So that's one thing that happens. And then the other thing that happens is, well, when you're doing it with a prop firm, it's a SIM account. They'll pay you out on the SIM account, but the orders that you submit are not going out to the market. So that's, to me, is like, if it's not a live order, you're paying for something fundamentally different, right? You trade with Iron Beam. I don't think that you pay for the platform with Iron Beam, but you still have to pay for the data, don't you? I think that with Iron Beam it's like a flat monthly fee though, right? Isn't it kind of like Tradeovate was, where you pay $100 a month instead? Yeah, your orders aren't going to the market, but your market depth is with real exchange data. That's true. Yeah, sure. And if you're practicing, it probably would be cheaper for practicing. I don't know. This conversation is always really hard for me, right? Because when I started, it was all about that. Was like, where am I going to get the cheapest data and the cheapest, because having the money was a problem, and that's not how I look at it anymore. I'm looking for the best platform, the best edge, every little tiny place where I can. Of course, I don't want to be spending money on something and then not getting anything back in the form of improved trading. Then that certainly happens a lot. But I'm looking for every little edge that I can, and so I'm not looking for the cheapest thing. And just as an example, I kind of learned over time that, having the cheapest commissions isn't worth it. That it really, really helps to have a broker where when you have a problem, the person knows what's going on and you trust them. Especially if you start making money, man. Nothing sucks more than you're making money and then your broker screws you over. I'd have to look at the Iron Beam, because my understanding was always that the CME had a rule that basically nobody can get market depth data without paying for it. And I kind of feel like that if there was a platform that gave you market depth data for free and the platform was free, then everybody would use that. But from my experience, Iron Beam is still not that popular. Although we did make a video about it when they first made that platform, and the platform was pretty good. And it's probably the fastest way to get started. You've gotten about 12,000. Oh, well, I haven't said anything about payouts. That's a whole different thing. If you want to talk about people not getting paid, then go and talk to the people that haven't gotten paid. I don't do that, so I can't really speak to it. When it will tend to happen to you and how to avoid it, and it's a whole subject. You could probably make a whole video about how to trade and the things to do to give yourselves the best chance of getting paid when you legit make money on a prop firm. But I don't do that. My thing's not a funded account trading. I hear every tiny edge. I ask myself, is that tiny edge justify the cost for me? It doesn't. I like Seer, but I drop them. I mean, on that, I don't know if that's a tiny little edge though, right? Like, Sierra Charts does not have an advantage over Jigsaw, for instance. If anything, they're about equal from a technical perspective. Jigsaw is better from an innovation perspective. That's where maybe you can get an edge. Is it worth $500 up front? I don't know. I paid for it 8 years ago and never looked back. And I don't sit here and ever said, man, I really wish that I hadn't paid that $500 in the beginning for the Jigsaw license. That was really man. It just never happens. I never even think about it because I love the platform and it works. Compared to, for instance, and I hate to say this, but it's the only example I can really think of where it was like this. When I was on NinjaTrader Brokerage, man, every day it was, I wish I wasn't on NinjaTrader Brokerage. So I got off of them, and then I don't have any problems, and I never think about who my broker is. Who's your broker? I use Edge Clear. I keep forgetting that it is in fact a holiday today. It is. Okay, so you're right. You're right, Hard. I could not, if I wanted to run my automated strategy, if I wanted to run my automated strategy live right now, I would not be able to. You're right. I would probably have to switch back to NinjaTrader Brokerage. If they offered rhythmic data, I would maybe put up with it, but we're making you a better trader than Iron Beam. Yeah, that's all fine and dandy until you experience the downsides of being on a cloud platform. So there's a multi-broker NinjaTrader license. I have a developer license, which gives me that multi-broker option and more. But it does not give you Rhythmic. Apparently, Rhythmic is a legacy multi-broker option that is only available if you bought a multi-broker license before 2018 or something like that. Isn't that dumb? And then there is Rhythmic for NinjaTrader Brokerage. But NinjaTrader Brokerage, when you're using NinjaTrader Clearing, at least, if you use NinjaTrader Clearing, then NinjaTrader... Blah. If you're using NinjaTrader Clearing, then you have to use CQG Continuum data. So that's my biggest gripe about NinjaTrader Brokerage is that when they moved over to using NinjaTrader Clearing, you can only use CQG Continuum. And I don't think that CQG, their setup is as nice as Rhythmic. Like, the quality of the data is about on par, but then Continuum is like a not as nice version of CQG. So I use it with Rhythmic. I like Rhythmic because I get all the level 2 levels. And I can connect to Rhythmic Trader Pro and forward the data to multiple platforms so that I can use Jigsaw and NinjaTrader alongside each other without having to use the bridge. Because if I use the bridge, then I can't use Jigsaw charts. Not that I use them right now, but at some point in the future, I'd like to be able to use them. NinjaTrader Clearing is slower than competitors. Well, again, the CQG Continuum data isn't as good. Okay, so there's that. And then the other side of it was that I just did not find their support to be very good. Like, the day that the Treasury, the micro Treasury yield futures went live, and I want to trade them, listen, you can go back and watch it. It's here. It's saved for all prosperity. I was the first market order in the micro 10-year Treasury. That's my claim to fame. I was the first market order in it. Because what happened was the product went live. Who's the product designed for? Retail traders. All of the brokers said, no, you're not allowed to trade it. It's too new of an instrument. We're not going to allow it. Like, if you can't trade it on NinjaTrader, who's going to trade this instrument? Like, it's crazy, right? This really is quite bonkers. So I had to get on email and everything and argue back and forth with them for about 3 or 4 emails before they would let me trade the micro Treasury yield futures. Like, it's too risky. Like, okay, listen, I might lose $50 on the biggest move that's ever happened. Okay, I'm willing to take that risk. Good grief. It was so funny to me, right? And then any time that I had an issue, which was frequent, by the way, like, we would have maybe 1 or 2 issues a month, and then I'd have to talk to their support, and I'd always get somebody that had no clue what was going on. So like I said, for some reason, and it's kind of weird to think back on it now, but when it was NinjaTrader Brokerage, I remember pretty much every day thinking, like, I wish I wasn't on NinjaTrader Brokerage. And then I switched over to EdgeClear, and I've never had a problem, and I've never thought about it again. So is it worth a few cents a trade? I think yes. I don't know if that explicitly made my trading better, but I think it was worth the price. Well, kind of poking around here to see if there was a shift. I didn't. Should note that, so we had this move up. It's a pretty good move for a holiday. It's a pretty good move. My guess is it might not recover. Oh, actually it did. did recover the drop from the overnight. But the thing that I'm seeing that I think is interesting is the flattening in the yield curve. This thing down at the bottom is the yield curve. So up is steep, down is flat. And you can see, like, during this day right here, right? Significant steepening. Not good, not good. But it has flattened out and is almost, like another day, and they could be at new monthly lows for flattening. This is the 2 and 10. This right here, this is the 2 and 10. You can see it right here if you can read really small print. ZTZN 2 4 -1. Yeah. So that's interesting that the yield curve moved today. They seem to be heavily focused on their web platform now and not really their desktop anymore. And that's what I was getting at with the cloud thing, right? The issue with the cloud platform is that they control it. They have control over everything. So you might want to say, you know what? I don't know if I really want to try this new feature thing yet. I'm going to let them, like in Jigsaw, there's a new beta version. I tried it a little bit, had some issues, went back to this version. No problem. If you're using a cloud platform, you can't do that. I think that a cloud platform can work for trading, but I don't think that it's optimal. And this is coming from somebody whose job is basically making cloud platforms. So, yeah, and they've been acquired by Kraken too. Yeah, that's true. And I'm not sure if I should be concerned by that or not. I don't know if I should be concerned by that or not. But I would really, really like to make my own platform. So if anybody wants to loan me like $5 million so I can hire a bunch of people and everything, we could totally start a new platform. I have a bunch of ideas. But I guess I'm open to a platform that could replace NinjaTrader. The key thing would be, is there another platform that comes along that creates a better ecosystem around it? Well, TradingView has a better ecosystem, right? Like if I was making indicators for TradingView, that'd be great. That'd be a much better platform to sell on. Except for that TradingView can't handle my indicators. So I was getting some stuff from ATAS, but they said they were going to send me a license to test with, and they didn't do that. So maybe they'll do that tomorrow, and we can install it tomorrow and try it. Because I know one of the guys, the guy that basically presented the idea that basically made the inventory cost basis, when he decided to go and program it, he went and did it in ATAS. So now mine has some stuff in it that his doesn't. So they're different. Let's put it that way. They're different. And I don't think that he sells his, but I don't know. That's something that always bothered me is like he just I wanted to talk and collaborate with him, but he just didn't seem to get it. He was just too busy doing his thing on his own. And I really didn't like what he was trying to do on his own, because his idea was, it should always mean revert, and I'll just keep adding more and more and more and more until it mean reverts. And I'm like, that's a really great way to blow accounts. But anyways, he used ATAS. So, and they're building out a little bit of like an in-app indicator store download sort of a thing. And it's C#, so it might not be too hard of a stretch to convert things over into ATAS. Like to convert things over to Sierra charts, probably really hard. So Although at some point, if I get the time, I do want to convert it over to CR charts because a lot of you guys use it. And I want you to be able to use that indicator. I was kind of hoping that I would have some time to do to program an ATAS today, but didn't turn out that way. I guess we did spend about an hour, if not an hour and a half, just talking now, huh? It was getting time. Well, I don't know what we're gonna do. I guess my default is I guess I should go up and check with my wife what's going on, if they're even awake yet. And if not, just lock myself in the room and do what I want. Like, screw them. They're not going to wake up early or do anything. And they don't want to do anything with me anyways. So I'll just sit on my computer and do what I want to do. But then I'm like, I'm not sure what I want. Kind of, well, no, I could maybe I could try and write a video. Maybe I could try and write a video. Kind of lost a lot of motivation on that sort of thing, though. I do need to make videos, though. I did do some stuff on the dog kennel, but I don't think, unless I'm gonna drill the holes, maybe I could just do it. All right. So finishing the dog kennel is probably the top priority. The dog kennel and the cableway. Although I would say, ever since I replaced the bookcase with that glass cabinet thing, no problems. Kids can come in. He will take apart the lights and the equipment and stuff, but they don't make a mess of the room. And especially if I'm in the room. So I can come in here and do stuff and have the kids around. And in fact, if I do that, they get bored of it quickly. And then I can't stay in here because they go into the other room and they cause chaos. And there's other problems, like he can open doors now. So we had to put child locks on all the doors. Anyways. So I guess I do have some things to do, but I'm going through one of those periods, like the low in dopamine cycle, right? Where like nothing really feels interesting to me. Is NinjaTrader best for automated stretch? What about? So I have not tried an automated strategy in Sierra. I would say that the NinjaTrader backtester is really good. I think that it is better than the other backtesters that I've tried. Like primarily the TradingView backtester is terrible, in my opinion. But I also still see some issues with it. You know, kind of one of the big motivating factors behind my indicators is to fix some of the deficiencies that I see in the NinjaTrader backtester. And even then, I would really like to make my own platform to do even more with that. But anyways, I guess I might also need to drive a kid. So guys, I think I'm going to get going. I think we accomplished what we needed to do. The two main things that we needed to look at today, we did that. So I'm going to get going. I will see you guys tomorrow. It's likely to still be a slow week, but it'll be interesting because it'll be the first like real summer. So we'll see how that goes. All right, guys. See you tomorrow. Stay excellent, team.